What's driving the better forecast, 0.5% better than where you were just in January?
So a big chunk of that, Sarah, is a consequence of the U.S. 1.9 trillion stimulus that was deployed. That's half of the upgrade, and the remaining half is that if you look around the world, it's still very much the case that countries continue to adapt to living with the pandemic. And so even though virus cases are high, the effect on economic activity has not been as bad as one might have anticipated. So I would say these are the two big factors.
For the U.S., the outlook, some say, is a little conservative at 6.4% growth for 2021. Is it vaccine stimulus? Talk us through what could get us even faster along. Some of Wall Street firms have us north of 7% growth for this year.
So we haven't included anything from this the more recent proposal of the infrastructure package, the kind of the jobs plan. So we don't have that. So I don't know what these other institutions are doing. But 6.4% is a very strong growth rate. I mean, in fact, if you look at large economies, the U.S. is the only large economy that in 2022 is expected to have a higher GDP than it would have had in the absence of the pandemic, based on our pre-pandemic projections. So that, there isn't another major economy in that situation. So these are very strong recoveries.
I noted that 2022 growth rate goes down to in the 3s for the U.S. Are you factoring in a tapering of the extraordinary asset purchases, the stimulus plan from the Federal Reserve, and potential liftoff from zero interest rates in your forecast between this year and next year?
No, our assumption is that interest rates will stay where they are into 2023. So the assumption is that the Fed will follow through on what it's been saying, and that there will neither be a substantial tapering of asset purchases or that there will be interest rates will stay low.
Gita, it's Morgan. I'm curious. I've seen a number of forecasts out there suggesting that the U.S. could actually be the biggest driver of this global recovery this year. Yet you guys have 8.4% growth for China, suggesting China could be. Why?
Well, if you look at, again, still the U.S. economy is much larger, and in terms of its impact, growing at 6.4% is a big positive. So if we looked at the impact of the 1.9 trillion package on global growth over 2 years, that's 1%. So, both China and the U.S. are large, very large economies, and their growth certainly is helping uplift the forecast. Now, of course, the difference is that in the U.S., in addition, what happens to interest rates really matters for the world as a whole. And so there is that second aspect to it, which is in terms of what's happening with interest rates and possible tightening of financial conditions that might come about if we have, if we see a much faster normalization of monetary policy.
No question, Gita, a lot of optimism out there, and your numbers reflect that. At the same time, France is in another lockdown. Many parts of Canada, including populous places like Toronto, are back in lockdown. We've got these new variants that we're watching from South Africa to Brazil to New York, which are still a little bit unknown as far as the vaccine's ability to protect against. How divergent are the forecasts based on the different stages that different countries are at when it comes to vaccinations and infections?
I think that's a really big feature of our forecast this time, which is very, very different recoveries, even within advanced economies, within emerging and developing economies. And one factor is indeed the pandemic and the speed of vaccinations. The rollout is not the same pace everywhere, and that is slowing down recoveries, even in some advanced economies. And in other parts of the world, most of the fiscal support that was provided in 2020 has been unwound or is unwinding at this point. So there's much less support in the system. So we're seeing very divergent recoveries. And, the only income group for which we actually have a downgrade are low-income countries, where we have a significant minus 0.8% downgrade this time around.
You mentioned that the new stimulus plan from the Biden administration is not in the numbers. Is that growth rate in the U.S. strong enough, on firm enough ground to implement corporate tax increases, individual tax increases? Can we handle that with still so many pockets of our economy under pressure and so many millions of jobs still gone during the pandemic? Do you think we can handle it?
Well, so the infrastructure, the package, the jobs package has a big component of spending on infrastructure, on bridges, roads, on water, and that would be very positive for the economy. On the tax front, of course, taxes going up can have some negative effect, but we haven't fully done the analysis. But we did look at what happened in 2017 when you went in the opposite direction, when corporate tax rates were cut from 35% to 21%. And we were exposed to, actually, a bit surprised at the supply side effects, in the sense that, we expected that to have a big boost on investment, and it did not. So if we, kind of go in the reverse direction, we don't expect the negative effects to be that large. Especially, I don't think it will offset the spending boom that we should expect.
Why do you think that happened? Money was just spent more on buybacks?
So that's what we saw. Money was spent more on buybacks. But I think one explanation is the fact that over time, because of rising market power, the profit shares of companies are very high, that these corporate tax rates at the margin didn't seem to be a big determining factor for how much of investment to do.
Shepard Smith here. Thanks for watching CNBC on YouTube.